Hello and welcome to this edition of Closing Trades right here on ET Now. Let's just revisit what the stock market is up to. And today one can definitely say that we're a lot more resilient as opposed to the globe, because the globe is the one which is taking a sharper knee-jerk reaction to Trump's tariffs. You've got Asia, which is closed in quite a fair deep into the red, although Hong Kong did recover from the session lows. When we came into trade, the market was a lot more lower. Shanghai actually perked up a little bit in the green, held higher by about 0.2% and close. Japan still continued to reel under pressure, even though those markets too, peaked up a little bit and rebounded a little bit from the session lows. It was down almost 700 points at one point in time, closed in with a 1.25% loss, about 450 points lower or so. For our markets as well, after that, initial knee-jerk gap down, you've seen a bit of a recovery coming in. Although intermittently you have seen the dips getting bought into and, the peaks also getting sold into. But we've largely been stable, you'd have to say. And I only say that in the backdrop of the last many trading sessions that we've had at our hands. Today is a lot better. Bajaj Auto, that's the one which is reeling under pressure. We did speak with the management earlier today and they did flag off concerns about currency devaluation, especially in the export segment. Remember, they do have exposure to markets not just in the Africa region, but also Mexico more importantly. Bajaj Auto is languishing quite a fair bit, about a 5% downtick coming in there. Hero MotoCorp, Maruti, Nestle, HCL Technologies, Titan, ITC, Bharti, these are all names which are also languishing in trade. But you are seeing some recovery in a BEL, in an SBI. Some of the metal names like Hindalco, Tata Steel are also doing quite okay. And Trent and ICICI Bank also holding out well. The breadth, surprisingly, within the F&O segment is slightly tilted towards the positives. And it is the advances which are taking over with names like Varun Beverages, HAL, TI India, Angel One, HPCL. These are some of the solid movers in trade this afternoon. But Shrishti, what about the newsmakers?
Well, certainly there are a couple of them. First up, let's put the spotlight on Tata Motors. Morgan Stanley has come out with a note on this particular counter. Maintaining an equal weight, target price is 853 rupees. What they're highlighting is that the EU Commission's industry action plan is on 5th of March. That will be the key to watch out for, that if there's any flexibility in the CO2 regulations, that could be a positive trigger for Tata Motors. And apart from that, the US market, the Land Rover retail remains strong is another point that they are highlighting, a mild recovery from the day's lowest point. Other than that, Samvardhana Motherson International, they have signed a multi-year contract to supply Airbus, selected as tier 1 supplier to the Airbus commercial aircraft, and that stock has also zoomed and recovered from the day's lowest point. And Gensol Engineering, that's one of the biggest laggards, or rather a 20% lower circuit is what we are seeing on that particular counter, as CARE rating has downgraded the rating on this particular, and especially their long-term loan obligations. The rating has been now given a default rating right now. So that's the take on Gensol Engineering. 20% lower circuit is what we are seeing right now on this one. Well, yes, apart from that, it's the oil and gas space as well, which is seeing a lot of action, and case in point being Oil India. We will chat that what's definitely in space within the oil and gas space. Let's connect with our expert then and try to find out that how are they looking at the trade setup. We do have Kunal Bothra, Nuresh Mirani, as well as Devin Choksi with us. A very good afternoon, gentlemen, and thank you so much for your time. Kunal, first up, give us your take on the benchmark indices. Good recovery for Nifty Bank. How are you seeing the index?
Yeah, good afternoon. It's a much better day for the indices, at least looking in the context of the last many days of the mid-cap and large-cap sell-off. I think today we're seeing traces of large-cap names showing signs of recovery. For example, names like ICICI Bank, you've seen Kotak Bank, you've seen Reliance Industries recovering after yesterday's 3% plus kind of a sharp correction. And then you have slew of mid caps and small caps where there has been strong evidence of volume backed buying. So that generally indicates that we are in a process of at least trying to get back into or correct from the deep oversold territories for many individual stocks. On the indices specifically, I think we should just about try to meander around the 22,000 mark. over the next couple of days. And I'm sensing that the pattern which we're seeing across the globe could probably deteriorate further, looking at the way the many of the global markets are now getting into a synchronized price correction. So I think even if we consolidate over here at 22,000 levels, say plus minus 100 to 100 odd points for the next couple of days, and if the global market starts to deteriorate, that would still be considered to be a slight positive sign for our markets.
Okay, let's welcome on board Deven Choksi as well. Deven, hi, afternoon. Time to buy yet, or do you think there could be some more pain in store?
Yeah, good afternoon, Asha. Yes, I think it is time to buy. We always tell people that I think when in a falling market like this, you don't buy everything at one go, but you accumulate. So I think keep accumulating, I think good quality stocks at a price at which I think they are currently available and add it to your portfolio. It's better to repent after buying than to regret it thereafter. I think as this is another piece of advice I think that we put across to all our investors. Because when the fundamentals of the business and the companies they remain intact, and I think they are not showing the signs of deterioration as much as I think the global turbulence is. In such situation, I think one will have to gather that confidence and conviction to buy into good quality stocks. Remember well that current fall in the market is largely due to the misbehavior of the currency, which is forcing some of the global traders to pull money out of the emerging markets, including India. And that situation has largely been played out. If that is so, then in such situation, even if they're selling stocks or even it slows down, maybe the local strength in the market is going to prevail upon. And that's where probably we believe that it is time to buy into some selective stocks. Say accumulate, I think it is the right word. Maybe I think quality stocks, I think it should be another word added to it.
Interesting. Deven, I'm just going to come back to you for your list of stocks as well. But Naresh, what's the market reading like? Any, sectors which you think are looking alarming? And especially what's happening in two-wheelers today with the fall in a Bajaj Auto, Hero MotoCorp as well is languishing. What are you making of the weakness in autos, specifically?
So, we were trying to form a base in both these names. Say Hero MotoCorp was trying to pause around that 4,000 mark. And it's broken down and it's coming back to the same price where it all started from. So it's started getting re-rated above the 3,300, 3,500 mark back in 2023. So that should act as a support. We are very close to that band. So actually it's oversold in the near term. We could be setting up for a bounce back going forward. Same is the case with Bajaj Auto, although that rally started all the way from 4,500, 5,000. But it's already given up a lot of move. Say closer to 7,000 odd levels would be a pause even for that stock as well. So not seeing further major corrections from here on, but would be a slow accumulate rather than hurry in right now.
That's the take coming in on Bajaj Auto. But with this, viewers, we'll now slip into a very short break. Don't go anywhere. We'll be right back. Welcome back to right here on Closing Trades, and taking a look at the markets. It's BEL, the stock within the defense bag that is definitely doing well for itself, and some of the other defense counters are having a good day. But Deven, just wanted to have your take on this one, because for BEL, we just highlighted yesterday that given the exposure to the European markets and the kind of rally these European defense counters are having, a likely beneficiary, or rather a sentimental impact, a 3% jump is what we are seeing in BEL. But help us with your overall take on the defense counters given the recent fall. Do you believe it's an attractive opportunity to go ahead and deploy some money here?
Yes, I think the corrections have been sharp in most of the counters, and probably I think meaningful correction as well. Because I think the kind of growth that we have seen in some of these counters in the previous year, largely due to the momentum-driven money which came into this counter, I think there seems to be out of this counter, and I think the stock prices are more realistic than before. Given that situation, it may be a good time to accumulate some of these companies with a horizon of 3 years and above from the investment perspective. Nothing that it is going to turn around immediately for most of the businesses, largely to the fact that these businesses have the continuity in place as far as the growth is concerned. Government lifts the material to a certain extent, I think, every year, and that's where probably I think they're given the orders. In such situation, I think assuming 15 to 20% kind of a sustainable growth for next 3 years is not ruled out in some of these cases, and that's where probably valuation in the vicinity around 20-25 times price earning ratio maybe justified for some of these counters if one wants to add them or accumulate them into the portfolio.
Interesting. Other than Bharat Electronics, Devin, where else do you think the correction has been significant and valuation looks comfortable right now? What would you recommend buying or adding to the portfolio?
I think majority of the financials, they look stable to me because I think on one side, the government is a big time spender of money in the infrastructure. And that's where probably I think the financials, they remain relatively more stronger than before. So certainly large NBFCs with a retail focus also included into it, or the housing finance focus also included into it. Along with, I think, the corporate banks who are resilient in selling their loans to quality borrowers. So from that perspective, I think some of the financials, they look really interesting in good position. At the same time, I believe that I think the likes of auto and auto ancillary, where the correction has been of a sharper degree, I think he's probably overlooking the kind of prospects that we are seeing in this sector. That will be the fact that I think once you have higher disposable income in your hand, your spending ability increases. And given the kind of correction of the stock price fall that we have seen in the auto companies, I believe that I think they, along with the ancillaries, they remain I think, relatively more stable to buy into the portfolio, not aggressively, but accumulate, I think, wisely into your portfolio with quality names. So here are the two areas where probably we remain more convinced. The capital goods segment, definitely, I think where the correction has been of a sharper degree, again, I think is giving an opportunity to buy into because next 3 to 5 years of visibility in capital goods segment equally remains, I think, interesting proposition. So I think one will have to select the companies more than the sectors though, but it is an opportunity out here, including in some of the renewable space where capital goods companies, the manufacturing companies, they play their roles.
All right, Devin, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. But back to the markets, then let's also look at some of the other counters that are doing well for themselves. It's the oil and gas basket that is holding up pretty well for itself. And Kunal, a quick chart check by you. Any of these stocks, BPCL, HPCL, we have touched them in the past, but definitely they were making lower lows for themselves. Any stock that is standing out right now?
So, yeah, I think all three of them are looking actually attractive, BPCL, IOC as well as HPCL. In fact, many of these stocks are actually seeing some good volume-backed buying. We need to maybe check this with the open interest data if there is an built up in terms of open interest for all three of the names. And if that's the case, then I would believe that this could be a good short-term trading pop for many of these stocks. And we could be looking at a further 3 to 5% upside at least over the very near term.
That's the take coming in on some of the OMCs given the movement in crude. But let's try and understand the news that actually shook the world. The much dreaded Trump tariffs come into effect on Canada, Mexico and China, showing that the US president is sticking to his guns. But experts believe that this could be inflationary for the US economy and cause disruptions to the global economy as well. Sumita Karir, my colleague, is here to help us understand the implications of this move.
Well, after Donald Trump announced 25% of tariffs on Mexico and Canada and 20% tariffs on China, China and Canada have retaliated. Canada, according to what reports are suggesting, as part of its tariff package plan, Canada is planning an imposition of tariffs on goods worth $107 billion that are coming into Canada from the United States. These also include non-tariff measures as well. As far as China is concerned, well, the Chinese Foreign Ministry, the Commerce Ministry of China, I beg your pardon, just a few hours back had stated that the imposition of tariffs on Chinese products going into the United States, these tariff measures were in contravention to the rules of WTO, and of course these undermine multilateral trading systems. And now China has announced 15% of tariffs on a number of US agricultural imports that includes cotton, wheat, corn and chicken, 10% tariffs on dairy products.
Well, thanks, Sumita, for getting us all those details. But, well, of course, the biggest talking point amidst this is how it will shape up the global economy. Could higher tariffs on steel and aluminium hurt the global growth? Ashesha explains the dynamics. Take it away, Ashesha.
Well, yes, several announcements have been made by US President Donald Trump when it comes to its implications on the metal sector. One, of course, additional 10% tariffs that have been announced in China. Apart from that, they've also initiated investigation on copper imports into US Of course, nothing has been finalized with respect to additional duty that can be levied on copper, but as far as steel and aluminium is concerned, additional 25% tariffs have already been levied, and this was announced a couple of days ago. Remember, as far as copper is concerned, several Indian players are into this business. So for example, 21% of revenue for consolidated revenue for Hindalco comes in from copper. Hindustan Copper and Vedanta are also impacted because of any changes that happened with respect to copper prices in the global market. But let's also understand tariffs were also imposed during his earlier regime. So what's different? This time, no exemptions or no exceptions have been granted. In fact, when we were talking to a couple of companies, managements were highlighting that they are hopeful of that company being exempted from these tariffs that are being levied. But Donald Trump has been very clear this time around, no exception or no exemption for any company whatsoever. So several Indian players might not be directly impacted, but indirect implications could be seen on several companies with respect to its implication on prices. So for example, all those countries which will not be able to export to the US will now be flooding other emerging markets into India, which means supply is expected to grow up, and as compared to demand, if supply rises, prices also could trend lower, and hence we could see indirect implication on metal prices in the global market, and that's how Indian companies could be negatively impacted. But guess what? Lowest metal prices, of course, is a positive for the consumers of these metals, and the most important beneficiary will be the auto sector, because nearly 20 to 25% of raw material basket constitutes metal for auto.
Well, thank you so much, Ashesha, as well as Sumita, for getting us all those details and putting in context that what Donald Trump tariffs would mean for the global economy and specifically how China is placed. But let's take this discussion forward with Sean Reen, China Market Research Group founder and director and author of the book, The Split: Finding the Opportunities in China Economy in the New World Order. Hi, Sean. Good to be speaking with you. First up, help us with your take on what's been happening globally in terms of the tariff war. It was US which had announced additional 10% tariff on the Chinese market, and today, of course, we have the China not sitting quiet and also telling that they are also looking out for retaliation measures. Give us a sense that how do you read into that, and how do you see this whole picture shaping up?
Well, it's been 95 years since the United States launched Smoot-Hawley on the world and unleashed tariffs and helped spur an even worse economic depression that spread throughout the world. I think Trump is playing with fire right now, and it's actually going to hurt the United States more than it's going to hurt China. When you look at it in the United States, the average car price for an SUV is $42,000. For a regular auto, it's $38,000. China's BYD just launched an NEV that's fully autonomous that sells for only $9,000 US. So by adding even more tariffs onto China, you're just going to import inflation into the United States and hurt the everyday American voter and the everyday consumer more. Now, for China, I'm actually not that worried. That's the one of the least of my worries about China's economy. Real estate's a bigger issue. Taxes are a bigger issue. Local government debt is a bigger issue, because for 7 years, the Chinese economy has been bulletproofing itself towards Trump and Biden's tariffs. In 2018, about 18% of China's exports went to the US. Now it's only about 14%. Only about 2.5% of the overall GDP is actually exports to the United States. China has been shifting its supply chains, focusing on exporting to the global south, or I prefer to call it the global majority, to places like India, to Thailand, to Saudi Arabia, to Kenya. China's going to be okay with this tariff war. The real pain, basically, Trump is taking a gun and is shooting America in the head and increasing inflation there. It's a terrible day for Americans. I'm American. I'm sad Trump is doing this.
Take your point, Sean. There are inflationary concerns, and what you're pointing out does make sense. But give us a sense that since the kind of size that China has in terms of the production, also in terms of the consumption, China is a behemoth, no doubt about it. And given the kind of announcements with respect to the commodity world, with respect to some of the other commodities related to the agri products, help us with some sense that which are some of the key products or commodities that can have the most of the hit and that can actually shake the global economy as well?
Well, here, like I said, one of the biggest worries I have for China's economy is not the tariffs, but it's real estate. Real estate prices have dropped about 20-30% throughout the country. It's starting to stabilize in tier 1 cities like Shanghai and Beijing, but in tier 3, 4, 5 and below, the real estate market is continuing to drop. This is going to have a major impact on commodities. I'd be concerned about iron ore. I'd be concerned about steel, aluminum, chromium. The whole commodity sector in the materials is going to be hit hard because of the trade war and because China's economy is still weak. Now, tomorrow is the kickoff for the 2 sessions in China's government where they set up the GDP growth numbers for 2025 and launch all types of new policies. I think that the policies are going to be less than what Wall Street wants. There's not going to be as much meat on the bone, and it's not going to be as much infrastructure and real estate geared policymaking that you might have had in the last decade or two. So overall, I'm quite bearish on commodities for the next week or two because I don't see the government in China launching a major stimulus. Instead, they're going to use targeted stimulus to try to boost consumption. And I think the 2 sessions, frankly, unfortunately, is going to have less meat on the bone than a lot of Wall Street wants. And I think that might hit confidence in the Chinese equity markets for the next day or two.
Another sector wherein China's advancement has actually impacted the global leaders and the global players, of course, is the technology. The kind of AI adoption and the advancement there is definitely making some of the US giants nervous. But with AI and semiconductor restrictions from the US now, how is China adapting to the tech leadership? What are your views on this?
So as you mentioned, I have a new book out called The Split, and the first chapter is looking at AI in China. And I argue that China is going to catch up and surpass the United States in AI, and we're already starting to see it. So you saw that DeepSeek, the language learning model from China, came out. It's as good, if not better, than OpenAI's ChatGPT. They're able to build it at a fraction of the cost, and the cost to the end user is much cheaper as well. There are green shoots in China's economy in the last 2-3 weeks since the rise of DeepSeek. What we're finding is the 10% of Chinese, the wealthy Chinese who are focused on entrepreneurship and investing, they feel that China can now overcome the immoral and oppressive sanctions and export controls from the United States, and China can be a major innovation powerhouse, which is why, and even though I'm concerned about Chinese equities for the next day or two, because of the trade war, I would actually be scooping up the dip on some of the technology companies. I love companies like Alibaba, Tencent, Meituan. They're going to do very well over the next 6 to 12 months because other countries, and I hope India is one of them, are going to want to buy top technology from China. They've realized that America has weaponized not just SWIFT, but have also weaponized technology supply chains. So you're not going to be able, if you're in Malaysia or Saudi Arabia, to buy American technology because the Americans might put on export controls on you. I'll give an example. Malaysia has spent billions and billions of dollars over the last several years hoping to be a data center place for the rise of AI. Now, because of Biden, they've launched export controls, stopping NVIDIA chips from being sent to Malaysia. So basically, Malaysia could lose billions of dollars because they can no longer be a data center house. I think China, over the next 3 to 5 years, is going to be an innovation powerhouse. Investors should look at it, and hopefully China and India can cooperate better and get rid of some of the tension from fighting over Ladakh.
All right, and Sean, help us with your sense that which market is actually looking more attractive to you right now, because what you are highlighting seems like that China is looking more attractive vis-a-vis the US markets right now.
Yeah, well, there's a couple things. The Indian markets have already dropped about 20%, but the MSCI PE ratio is still at 20 for India, only 11 for China. So there's still run for China to continue to grow. I also am very negative on the United States right now. It was already too high and too large of the world's proportion or ratio of cash was in American equities. So we're facing, I think, a big drop with some of the chaos and instability in the United States in DC. American consumers are going to cut back on their spending. There's a lot of concern about where an American manufacturer can base their factories. They can't do it in China. Can they do it in Vietnam? Can they do it in Mexico? Can they do it in Canada? Because at any point, the mercurial Trump might slap tariffs. So it's causing a lot of unease, not just amongst consumers, but also in the C-level suites of Fortune 500 companies. This is going to cause a crash in the American stock markets. I don't know when. It might happen next week. It might happen a year from now. It might happen 5 years from now. But the United States is going to have a major systemic financial crash because they have too much debt and too much stupid decision-making in DC. So where investors should they put the money? It's not going to be Europe. It's not going to be India. It should be China. We've got a stable, well-run, sane, pragmatic government system that allows for businesses to know where they can be investing over the next 5-10 year period. Valuations, like I said, are still too low in China. Retail investors should be putting 10-15% of their overall net worth into Chinese equities.
All right, anticipating a bigger crash in the US markets. Let's see, at least for now, they are seen to be taking a bit of a U-turn. But indeed, it was great having you, Sean, on the channel. Thank you so much for taking the time out and speaking with us. But
thanks for having me. Read the split. It's in India now.
Sorry, I didn't get you there.
Oh, read my book, The Split. It just came out in India last month.
All right. We'll definitely do that, Sean. Thank you so much for taking the time out and giving us a perspective that what's been happening in China and which markets are looking attractive to you at this point in time. But with this, viewers, it's now time to slip into a very short break. Don't go anywhere. We'll be right back with more.
Back with closing trades, right here on ET now. Closing in pretty quiet, holding on to that 22,000 mark. More importantly, it's the recovery in the broader end of the markets, which is heartening to see because that's where you've seen a bigger move. Bandhan Bank is now holding up 5%. Angel One is staring at a 4% gain. There's HAL higher by 4%. Varun Beverages is looking very smart. And HPCL also, which is now almost knocking on a 6% gain. But good time as any with half an hour left to go before we wind up for the day to get in some closing ideas too. Naresh, what's on your list?
So the stock I would be looking out for is PFC, which has corrected quite a lot, making a double bottom around that 360, 370 mark. So expecting a bounce back here towards 395, 400 in the short term.
What are your closing ideas?
I'll go with the buy on ONGC, a stock which is down almost 3% in the morning. I think at current levels of 225 thereabouts, it looks very attractive and the stock forming a triple divergence, which makes the risk reward also quite lucrative for the short-term trades.
All right, so that's the take coming in from both of our experts. And ONGC specifically, today Antique has come out with a very interesting note on ONGC as well as Oil India, highlighting that after the recent correction of almost 50% in the past 6 months, the valuations are now looking very much attractive, and any little upside even from these levels in the crude oil prices will directly benefit the upstream players, and that's their take on Oil India as well as ONGC. Both of these stocks are having a good day today. But with this, let's also welcome Anand Tandon, independent analyst on the show right now. Hi Anand, good to be speaking with you. First up, give us your take on the markets. Seeing like a bit of a recovery, the broader markets are also participating in this one. But what is looking interesting to you right now?
Not a lot. Yes, the market is looking a little oversold, and therefore it is possible that you will get a mild recovery. I would hesitate to rush into buy. I think there are structural problems now in the Indian market, primarily among them being the IT sector. You have to remember that for the last 2 decades, the biggest driver for domestic consumption is actually the number of people who are employed in that sector. That now seems to be behind us. What are you going to do when you have 2 lakh people who are being added to the IT workforce, not being employed anymore going forward, and perhaps some of them slowly being laid off? That is a problem that is not receiving enough attention, and I don't think it's a cyclical issue. It's a structural problem. We need to find another industry which can grow in the same way. Till we do that, I think you will find that the market will go searching for lower levels as we try and adjust for lower expected earnings and perhaps a slower growth in the overall economy.
Okay, Anand, stay on with that thought. Just going to get back to you. But let's just shift focus to a very interesting note coming in from ICICI Securities and the food delivery majors, Swiggy and Zomato, even as they maintain their buy stance on both the counters, the brokerage firm has actually flagged off some concerns with regards to the cash burns in the QCOM segment, especially after Dipinder Goyal's tweet. Let me take it across to Snehi and get all of that perspective in. Snehi?
Absolutely. So interesting note coming in from ICICI Securities on two of the quick commerce and food delivery majors, Swiggy and Zomato. For Swiggy, they've reiterated their buy rating with a target price of 740 rupees per share. And for Zomato, they've reiterated their buy rating with a target price of 310 rupees per share. One of the most important points that they are highlighting is that food delivery segment is being completely ignored by investors, and that is leading to a lot of pessimism when it comes to both of these stocks. Now, they have said that they have analyzed long-term historical data, and it suggests that every time there was a noticeable tax cut announced in the union budget, consumption was had noticeably gone up in those years, the likes of FY6, FY11, FY13 and FY14, which is why they also believe that when this budget cut has been announced for our FY26 budget, consumption could go up and it could help companies like Swiggy and Zomato. Also remember that when the Q3 numbers came out, quick commerce was a segment that was under pressure, but other than that, food delivery as a segment has done well for both of these players, Zomato as well as Swiggy. They also say that concerns have been overbaked for the stock prices for both Swiggy and Zomato. Concerns were regarding the increasing cash burns in the quick commerce segment due to higher discounting by Zepto. Today we've seen a comment coming in from Adit Palicha as well, who is disregarding Dipinder Goyal's statement on how much cash the company has been burning. Swiggy's on the consolidated view is now trading at an average 30% discount to par value for the food delivery business, and this implies a negative value for the optionality success in quick commerce. Zomato on the other side is trading at a value that ascribes nothing to quick commerce business, which is why the main crux of both of these businesses lies in the food delivery segment going ahead. What ICICI Securities is also pointing out is that the anomaly is unlikely to sustain for a long time, especially given the robust outlook for discretionary consumption in May of this year, which is when this budget impetus will start kicking in and will start showing some effect in consumption. So overall, that's the note coming in from ICICI Securities, positive for both Swiggy and Zomato.
All right, so that's the ICICI Securities take on both of these measures. But Anand, help us with your take on Swiggy as well as Zomato. They have already witnessed quite a bit of correction. What are your thoughts on the same?
Okay. First is, if you look at quick commerce, what exactly is the moat other than the fact that you have a lot of money? That's been a challenge that I have not been able to understand quite clearly. So it's a question of you being able to execute at very thin margins a business which theoretically can grow very large because there is supposedly unlimited demand. Now, you put that in the context of where I just, in my earlier remarks, I had mentioned that I expect to see a slowdown in terms of domestic consumption going forward. And then suddenly some of these things don't look that attractive anymore. As I said, my biggest fear is we have a structural issue on our hands. We are not generating high-paying jobs. And IT was the key driver of almost everything in terms of middle-level salaries that you were expected to get. It isn't happening now, which will mean that things like discretionary consumption, despite the cut in the income tax, etc., will not be as effective. And going forward, we need to find another industry which will replace it. I am not that bullish on domestic consumption for the moment.
That bullish within the domestic consumption pact, but Anand, don't you feel that now our day-to-day life has been impacted the most in terms of what the kind of comfort we are getting from these platforms like Swiggy and Zomato? And when I talk about aviation as well, the number of flyers that we have right now and the number of people that are choosing flights over railways has gone up ahead. Help us with your take that don't you feel that some pockets within consumption still have value in terms of the growth?
There is no value in the Indian market even today. Let us be clear on that. That said, will consumption absolutely vanish? No, we are still a economy which continues to grow and have people. And as people come up the curve, they will be spending. So it's not like one is arguing for consumption vanishing. What one is saying is that to be able to grow sustainably in a way that can benefit the stock market for companies which are trading at 60, 70 P 5 years from now, you need to have a kind of growth rate which is exorbitant. You need to have companies being able to deliver upwards of high teens or maybe mid-20s kind of numbers in terms of volume growth, not just in terms of being able to expand a new place without earning any money out of it. That has to be a natural progressive growth. There aren't too many businesses along that lines that can actually deliver that. You can see that whether you're looking at two-wheeler sales, whether you're looking at even regular FMCG kind of sales. Where is the growth? The volume growths are all tepid. They are mid-single-digit volume growths. And I'm saying this is without the effect of IT vanishing as an earning source for most people. That will go and drive that demand growth even lower. As I said, it's not that I'm saying your demand will vanish. All I'm saying is that the growth is such that the market has to correct a lot more.
Sure, get that. Anand, interesting thought there. We'll definitely talk a little bit more about that, but after this very quick break.
Welcome back to Closing Trades, and the biggest talking point of the day is definitely the tariff impact and its implications. So let's understand the impact of US tariffs on the chemical space, and Sharad joins in with the analysis. Take it away, Sharad.
Well, important tariffs have been imposed by US when it comes to China, but largely the Indian players, what we are hearing from the street is the impact is not ascertainable right now because there might be a series of retaliations coming against both the countries. Now, of course, India is an important player in the chemical ecosystem as well. And as per our channel checks, it suggests that Vinati Organics, that's roughly 31% of the exports, and Naveen Fluorine, 21% of those exports, are having no major competition from China in the US. Also, interestingly, no significant benefits from US tariffs are expected to come in, as most of the chemical companies in the recent Q3 con calls have stated nothing as such when it comes to the benefits. Currently, if you look at it on a macro basis, most of the chemical companies are working for the backward integration, and also there is a sustained supply of Chinese products as well, hampering the raw material market. So on a domestic basis, of course, the government is looking at more anti-dumping duty, but this is a very developing story as how the tariff arbitrage will play out between US, China and India, and what would benefit the Indian chemical players. Now, setting up a chemical plant in the US is almost 1.5 to 2 times costlier, making the local manufacturing in US less viable. So there might be opportunities when it comes to the Indian chemical players, but it's a developing story and we'll be getting you more impact analysis as announcements come.
Right. Okay, Sharad, we'll leave it at that. In the meantime, it's clearly the commentary on tariffs has sent jitters across world markets. But what do experts have to say about that? The potential impact of these tariffs and, of course, the way forward too. Let's listen in.
The fact that we are now in an open trade war tells you that it's not going to end just with Canada, Mexico, and China. If he's going to go all out against these guys, please let nobody think he will not come after lots of others. If you ask me, what he is doing is disastrous for the USA as well as the global economy. I mean, that would be my view. Mr. Trump seems to think that because on his last occasion, when he put up some tariffs on steel and aluminium, there was no great rise in inflation. And because there was no great rise in inflation, he seems to think that he will get away with it this time too. I'm afraid the situation is very different.
Series of concerns which is being expressed. One started from high valuations. Indian market has been one of the best performing market. Across the board, Indian markets have done well, respect to the market cap. And having seen a significant rise, there was some expectation that this valuation is not sustainable if there is a slowdown in the overall momentum and the growth momentum. Market knows a little bit ahead of time in terms of price correction. That's why what I feel the correction that we have witnessed is largely, I think, pricing in most of the uncertainties it has been created. I would say we are on the last leg of uncertainty.
The Chinese leadership has said a tariff war doesn't help either of the sides. It harms both. So I think that is where it will end. But the time frame for its ending, whether it's going to be 6 months or 1 year, one doesn't know.
We have a very strong long-term view on India. A lot of investment into India is based on index funds. And to the extent that retail investors and some institutional investors are selling their emerging markets funds or their Asia funds in general, that's going to affect India.
Okay, that's some expert opinion coming in and what they make of the impact of tariffs on the world. But Anand, just coming back to your point on India, the fact that you were calling it a structural, meltdown of sorts, where do you think is a safe haven right now? And is it equities at all, or would you recommend just sitting on cash or maybe some other asset class?
Well, there are no other very good asset classes to sit on. At the end of the day, if you look at, for example, what tariffs do, if the tariff is on a product which is inelastic in demand, it actually hurts the country which is putting the tariff because they will see inflation. By and large, take pharma, for example, where will the US buy from if they don't buy from India and China? So therefore, they have to continue to buy, which means that the product will be sold at a higher price. If inflation in US becomes sticky, what do they do with their interest rates? They can't cut it down. We already have a very weak currency in India. If the US cannot bring the interest rate down, neither can we, because we already are having a problem keeping a currency where it is. A weaker dollar, slower growth, and money going out of the system doesn't behave well for currency stability. So therefore, you'll have to leave your interest rates higher, which will mean that you will not be able to have the monetary policy helping in terms of pushing up demand. Now, if the interest rates also remain higher, yes, new flows into debt may actually do better, but the older money that is in the debt is actually having perhaps a mark-to-market loss. Overall, what I'm saying is that there are not too many assets right now which are looking very attractive. You have to lower your expectations from the market, whether debt, equity, or real estate, and assume that we've had a great 4 or 5 years of run. From now on, you'll have some normalized return, which will be perhaps subpar till the next cycle starts. At the end of the day, markets are cyclical, and the markets market participants have to realize that.
So not many choices left when it comes to the asset allocation right now. That's the take coming in from Anand. But just a few minutes left before we shut shop, and it's been a decent day, at least for the banking index. Some of these banking majors like SBI, IndusInd, they tried to send some bit of a support to the banking index. Nifty Bank is up around 180 points right now, and Nifty 50, at least for today, was able to defend that 22,000 mark. But before we close the day, let's also get in some BTST ideas from our experts. And Kunal, tell us any stock for the BTST or STBT trade?
Yeah, I'll suggest two buy calls, and the first one is around Bandhan Bank. Even after this 4% plus kind of a move, the stock is now challenging its 50-day moving average, and looking at the indicators, the breakout could probably be happening for the stock over the very near term over the next couple of days. So anticipating that and suggesting a buy with a short-term target of 150, stop loss to be kept at 139. And the second is a buy on BHEL. It's more of a contra buy, the stock which has been beaten down significantly, more than a 40% plus correction over the last 6 to 7 months. Apparently just around the sub 200 mark, 190 levels thereabout. The stock looks to be a good contra buy at current levels, risk reward fairly attractive. Look out for targets in the range of 204, stop loss to be kept at 184.
Alright, so those are the two buy calls coming in on two stocks. One is the banking stock Bandhan Bank, one of the underperformers, seeing a good day today, and BHEL is another stock. But Naresh, what about you? Do you have also some of these buy calls, or would you like to hedge with some of the selling ideas as well?
So two buy ideas. First is a buy on PFC. The stock has corrected a lot and shaping up for a bounce back. Stop loss at 378, target price of 395. Second is a buy on Indigo, which clearly is a relative outperformer and on verge of a breakout today. Stop loss at 45.50, target price of 4,700.
That's the take coming in on some of those interesting trading ideas. In the meantime, oil and gas definitely is going home a winner today, and today is a lot more stable as opposed to what we've been used to of late. Infrastructure, cap goods, textile, pharma have all seen a rebound today. But Snehi is here actually to walk us through how the trading day has been so far. But Kunal, Naresh, Anand, thank all three of you for joining in. Snehi, over to you.
Well, absolutely. Let's take a look at how today's trading session has panned out. And we have been very range bound when it comes to the Nifty. But from the day's lowest point, remember, we had a real scare in the first half of the trading session. The first couple of minutes, we had opened below that 22,000 mark. We have recovered smartly from at least the lowest point of the trading session. It's a 120 point uptick coming in from the lowest point, and 47 points higher on the spot is how we are going home with the Nifty today. A 0.2% cut coming in, but nonetheless, we are comfortable above the 22,000 mark, at least for now. Sensex also has seen slight bit of a cut coming in today, 0.2% cut, but well, it's much lesser compared to the kind of carnage that we've been seeing recently on D Street. Moving on
let's throw the light on the broader markets today. The mid-cap index is absolutely flat, not doing anything in today's trade. It's the smaller end of the market that has seen a stellar recovery today, outperforming the entire market, almost a 0.7% uptick coming in on the small cap index alone. The advance decline ratio is in the favor of the advances today, not by a lot, but nonetheless, on the back of that, the India VIX is up 0.8%, and it's a slight uptick coming in, but we're still below the 14-15 levels, so at least looking healthy for the India VIX right now. Let's take a look at what the Nifty Bank is up to right now. 0.3% uptick coming in, so this is also a space that has been lending some support to the market today, and it's the PSU banks that have done very good in today's trading session. You have the likes of Union Bank, IOB, SBI, of course, on the back of that Citi double upgrade coming in from sell to buy. They've also hiked the target price to 800 rupees, so that is also looking good for SBI. It's the biggest Nifty gainer today, and that has lent some support to the overall markets in trade today. That's SBI. We are talking about a 3% uptick coming in on SBI stock price in today's trading session. Other than that, you have names like Maharashtra Bank, Indian Bank, Canara Bank, Bank of India. All of these stocks have done pretty well in today's trading session, giving a fillip to the Nifty Bank index. So you have PSU banks that are your top winner, followed by Nifty Bank, Nifty Energy. On the flip side, metals were slightly under pressure, very nominally flat, but nonetheless a slight negative cut coming in over there. You have Realty, Pharma, FMCG, IT and Auto. Auto being your most, the biggest sectoral loser in today's trade. A 1.5% cut coming in on the Auto index. The likes of Hero Motor. Hero was down 3.5%. You have Bajaj Auto that was trading with cuts. Eicher, TVS, Maruti, Ashok Leyland. All of these stocks were under pressure in today's trading session. A couple of stocks to highlight on the back of some individual news flow. Watch out for Swiggy and Zomato, because these stocks have done very well in today's trading session on the back of an ICICI Securities note coming in, wherein they've reiterated their buy rating for both of these stocks. So that is looking good for a couple of these stocks. SBI, of course, on the back of that double upgrade coming in by Citi. You have a whole lot of other stocks also to watch in today's trading session. You have Sudarshan Chemicals on the back of the acquisition of UBAC Group. That's also a stock that has done pretty well in today's trading session. So that is looking good. And other than that, Zydus Life was in focus on the back of that support that they have received from the Gates Foundation to develop the world's first combination vaccine. So positive news flow coming in for Zydus Life, but that is closing rather flat in today's trade. So these are a couple of stocks that were in highlight in today's trading session. But that's how we are shutting shop for the day. Nifty, a very mild cut coming in, but nonetheless we have ended above the 22,000 mark for the Nifty at the close of today's trade.